Yield to maturity is a financial metric used to measure the total return anticipated on a bond investment if the bond is held until it matures. It represents the average rate of return earned on a bond investment over its lifetime, assuming that all interest and principal payments are reinvested at the same rate as the initial investment. The yield to maturity formula takes into account the bond's current market price, its face value, the time until maturity, and the coupon rate. The coupon rate is the interest rate that the issuer promises to pay bondholders, usually expressed as an annual percentage of the bond's face value. The face value is the amount the bondholder will receive when the bond matures, typically set at $1,000 or a multiple thereof. The yield to maturity calculation is based on the present value of the bond's future cash flows. The present value is calculated by discounting the expected cash flows back to their present value using the prevailing interest rates. The yield to maturity is the interest rate that solves this equation and equates the present value of the bond's cash flows to its current market price. Yield to maturity is an important metric for investors to consider when making bond investments. It provides a way to compare the expected return of different bonds with different coupon rates, maturities, and prices. The higher the yield to maturity, the higher the expected return, assuming that the bond is held until maturity and that all interest and principal payments are reinvested at the same rate. Yield to maturity is often used by investors to estimate the fair value of a bond. If the current market price of a bond is lower than its yield to maturity, the bond is considered undervalued, and it may be a good investment opportunity. Conversely, if the current market price is higher than the yield to maturity, the bond is considered overvalued, and it may be a good time to sell the bond. The yield to maturity calculation assumes that all interest and principal payments are reinvested at the same rate as the initial investment. This may not always be the case in practice, as interest rates may change over time, and investors may not be able to reinvest their cash flows at the same rate. Additionally, the yield to maturity calculation assumes that the bond issuer will make all payments as promised, which may not always happen in reality. Yield to maturity is affected by several factors, including the bond's credit rating, the term to maturity, and prevailing interest rates. Bonds with lower credit ratings typically offer higher yields to compensate investors for the higher risk of default. Bonds with longer maturities also tend to offer higher yields, as investors require a higher return to compensate for the additional risk of holding the bond for a longer period. Prevailing interest rates also affect the yield to maturity, as higher interest rates will result in a lower bond price and a higher yield, and vice versa. Yield to maturity is a measure of the total return anticipated on a bond investment if the bond is held until it matures. It provides a way for investors to compare the expected returns of different bonds with different characteristics. While the yield to maturity calculation assumes certain conditions that may not always hold in practice, it remains a valuable tool for investors to evaluate bond investments and estimate fair value.